It's such a pleasure to be with you right here on India Tonight on ET Now, India's #1 business channel. I'm Supriya Srinath right here on our news center in Mumbai. We take you straight across to a top story on the show this evening then. GST race is indeed entering the last lap. The designated council today reached an all-important deal on a 5-slab tax structure, giving hopes that the April 2017 deadline could well be met. Finance Minister Jaitley, who chaired that meeting, said there will be zero tax on essential items, which constitute nearly 50% of the consumer price index basket. The lowest rate has been reduced to zero, or actually 5% if you look at the number there, although the highest slab has gone up to 28% from 26% that was suggested earlier. The two standard rates will be 12 and 18%. There will be a cess on demerit goods like tobacco, pan masala, aerated drinks and luxury cars, apart from a green cess, and the proceeds will be used for compensating the states in the first 5 years after the switch. Speaking exclusively to ET Now, Chief Economic Advisor Arun Jaitley said there will not be any big changes in the effective tax rate post the GST switch. Top CEOs are, however, keeping their fingers crossed, waiting for the fine print on the classification of categories, that is. The big breakthrough on the GST and what it means for the Indian industry and the Indian consumer is the top story right here on India Tonight.
The GST rates have finally been sealed. The GST Council on Thursday finalized a 5-slab structure with minor tinkering, giving hopes that the April 2017 deadline could be met. The states' proposal to raise the top slab to 28% and lower the rate on essential commodities to 5% was approved without much opposition. Finance Minister Arun Jaitley, who chaired the meeting, said there'll be zero tax on nearly half the items in the consumer inflation basket.
There will be a zero tax rate in which several items, which approximately constitute 50% of the consumer price index basket, would be included. Food grain used by common people would be in this category.
The standard rate on goods and services will be 12% and 18%, and a committee of secretaries have been given the task of dividing goods and services between these rate bands.
There will be two standard rates of 12% and 18%. Some people had demanded that the standard rate be 18%, but considering the inflation impact of just having one standard rate, we have had two standard rates of 12 and 18%.
The next big hurdle is the dual control between states and centre, which will be taken up on discussion on Friday. While states have been pushing for increased powers, the centre wants some control in tax administration at all levels. Will there be a deal tomorrow? Watch this space. Gaurang Sinha, ET Now, New Delhi.
Now, those who matter and when it matters, they speak exclusively to ET Now, and which is why we get you the actual architect of the GST who laid out his first report, and that's Chief Economic Advisor Arun Jaitley, one of the key architects of that rate structure, who said that both states and central governments will make no additional revenue from the GST. The rates are revenue neutral to an extent. Let's listen in to an exclusive chat that he had with my colleague Ruchi Bhatia.
I think, remember that the whole exercise is revenue neutral. It's protecting people at the lower end, and because of efficiency gains, I think that on balance, both for the poorest and overall, it will be revenue more than revenue neutral. I mean,
so as far as the compensation pool is concerned, what all, where are we looking at getting all the money going in for the compensation?
From basically, it will be cesses on 5 products: the clean energy cess, cess on tobacco, cess on pan, cess on luxury cars, and a cess on aerated beverages, with the clear understanding that on all these products, the incidence will be the same as what it is today. It will not be lower.
Yeah. So my last question, and this on the sunset clause for the compensation, how is that going to function, and what kind of how will the sunset clause be reviewed? If you could just help us understand that.
See, the sunset clause by definition, compensation is for 5 years, so after that it lapses. But even before that, as the finance minister said, on an annual basis there'll be a review, because you could be collecting too little, you could be collecting too much, so you have to take these decisions annually. And that will be built into the legislation itself, how it will be addressed.
So are the states on board with respect to this decision?
Yeah, absolutely. Yeah, it was I have to say, I've said this many times, it was a really fantastic, experiment and exercise in cooperative federalism with, consensus, unanimity on almost everything.
Now, to understand the rationale behind the government's decision on a 4-tier, actually a 5-tiered structure rate format, and the impact this will have on consumers like you and me, we're going to break this down and take it forward with Gaurang Sinha and Sriram Iyer. Thanks very much, both of you gentlemen, for joining us. Gaurang, to you first. What is the government's big play here?
Well, you've got a big coup, in fact, today, Supriya. You've got the two major discussions, which were really the tough decisions which were to be taken in this meeting of the GST Council. It was a GST rate, and of course, there's dual control. On the GST rate, certainly the government, with a little bit of give and take on the top and the bottom slabs, if I may call the 5%, the bottom slab here, you've got the centre who had proposed a 6% bottom slab as far as essential commodities are concerned. They've taken into account states' concerns, brought it down to 5%. The top slab again has been raised to 28% to cater to the state's demands that the tax incidence overall should remain the same, and the balance amount on demerit goods, of course, will be charged to the additional cess, which will again feed into the compensation fund. So it's really the centre taking sort of a position where it's catered to the state's demands, but kept firm on that demand for a compensation cess, because remember, that's essentially what's crucial to funding whatever compensation the centre has to pay out for the next 5 years, without, of course, constricting its own fiscal space. And therefore, it's really been a good play here between the centre and the states in terms of the key demands, and really there has been a lot of agreement there, which is a good thing. The second major aspect of this GST Council meeting, and this is now something which really could be a make or break as far as that April 2017 deadline is concerned, is the question of dual control. You've got, like the Kerala Finance Minister, in fact, you've got state authorities now agitating in the centre, asking that their rights to tax must be, in fact, kept autonomous, kept protected. And there is that entire demand, the 1.5 crore rupee threshold, which the states are now stuck to. In fact, you remember the first meeting of the GST Council, there was actually an in-principle agreement that the centre would continue to have the existing service taxpayers, but the states have gone back on that since. And now the key demand coming from the states, in fact, will be that the states and the goods and services must both be shared with the centre and the states, and there should be a hard threshold of 1.5 crore rupees. This is not something which the centre is going to be okay with, and particularly big service providers like the internet services, banks, telecom companies, in fact, will have a lot of trouble dealing with this new regime as well. So it's going to be a tough call tomorrow between the centre and the states if the dual control issue is really resolved, whether at all the centre and the states can come to possibly another compromise like they have with the GST rates. But it's certainly going to be a tough one to look at if you look at tomorrow's proceedings. Back to you.
Tough consensus to come about on the rates, and I think the bigger thorn in the flesh is going to be the dual control. But thanks very much, Gaurang Sinha, for getting us those details. Hold your thoughts there, because we're going to grope in Sriram Iyer to make us understand how does this entire exercise on rates really impact consumers like us there, Sriram. Is it going to pinch me more, or should I be happy with this GST rate structure?
Supriya, as we've heard from person after person, from the Finance Ministry to the Chief Economic Advisor to the Finance Secretary, each one of them has tried to tell us that, the life doesn't change as much, because the government has tried to ensure it makes as much money as it does right now, while keeping the pinch on us just at the same level. Now, there are certain things that will change for sure. All product categories that are right now being taxed between 3 and 9% will fall into the 5% tax category. So some of those essential items, that the daily use items, some of them will get expensive, some of them will get cheaper, but the overall burden on you, like the Finance Minister pointed out, 50% of the CPI basket is zero tax. So essentially the idea is to curb inflation, keep it within controllable levels, and as well as make sure that the common man does not feel the pinch. Now, there are certain things that will get expensive. Actually, there are certain things that will get cheaper. I want to highlight that first. One of them is the refrigerator. Some of the white goods which have right now been taxed at about 30-31%, they will fall to 28, and Finance Minister has indicated that some of them will fall into 18, and that will be a very good news when it actually happens. So refrigerator is one thing which is on the criteria, as sources have told us. Now, why is it going to happen? Because finance or rather the government believes that refrigerator is something that everyone needs one, and unlike an air conditioner, one thing that's going to get really expensive definitely is eating out. If my parents couldn't stop me from going to bars and restaurants, GST will, and it's been happening every year. 18% tax on services is really going to pinch hard for people who like to go out and eat every day. And Supriya, if you're planning your next big car, a Merc or a Jaguar or a BMW, your deadline is April 2017 because demerit tax.
I'm not planning either of that, but yes, what your folks couldn't control you to do, the finance minister certainly will. But thank you very much, Sriram Iyer and Gaurang Sinha, for breaking it down for us. As far as the GST is concerned, the big picture and the impact on you, the consumer. Industry veterans, meanwhile, have their fingers crossed. Top chief executives tell ET now that the real impact will be known only after the final classification of categories is done.
I think overall these 4 rates are reasonable. However, the final point will lie in how various individual categories of products are put into each of the rates. That's very important. 28% is quite high, and I don't agree that the current rates are as high as 31%. It varies from product to product, but until we see the final actual fitment of each type of product into each rate category, it's difficult to comment. I don't believe that the compensation required will be anywhere near 50,000 crores, because what the government is forgetting, what the entire council is not taking sufficiently into account, is because of the nature of the GST, evasion of indirect taxes will come down dramatically. My expectation is collections will be huge. My expectation is that the states, by and large, except for 3 or 4 states, will not need to be compensated. So my feeling is these additional cess, and he has mentioned that also, that he would gradually take it off in 5 years' time, definitely. I hope it will come off soon because that's what is going to lead to a lot of economic development.
I think this 4-slab structure, or rather the 5-slab structure, including the zero, is a very good move. What it does is the government has managed to, at one hand, ensure revenue neutrality. On the other hand, it has ensured that the common man is protected from inflation. What will happen essentially is there will be alignment of the current tax incidence to the slabs because they are close to each other. More than anything else, I think overall it will make life simpler. And thirdly, a lot of FMCG players compete with a lot of unorganized players. I think with compliance, it will help. So I think it's a very good move for the industry. And the biggest thing which is important is that it has protected the common man from any inflation impact.
Impact on a company will once the classifications come out. So while the rate, while it is important, even more important is the classifications. Because in a company like ours, which has got such a wide array of products, ranging from Ayurvedic medicines to food and to cosmetics and toiletries, the classification assumes crucial implications. And as of now, there is really no clarity which we have in terms of what goes where. We'll know in a week's time, and that would really, we will know the impact on our company at that point in time. I think one can expect a fair amount of disruption, a fair amount of initial chaos when the GST implementation begins. We saw it in the VAT implementation, but hopefully things will settle down very quickly.
All right, to take that very special discussion forward on GST rates, where the consensus has finally been reached, we are joined by 3 very special guests. Sunil Kant Munjal, Swaminathan Iyer, and of course Mukesh Bhutani, who joins us all right here on ET Now. Thank you very much, each one of you, for being with us. Mr. Munjal, you've got your skin in the game, so to say. Must begin by talking to you about the slabs that have been decided. If you include the zero rate, there are 5 slabs. So there is a multi-layered GST that we are perhaps going to see. One wasn't expecting a utopian one-rate GST, but are 5 slabs a tad too much, or do you believe this is a political reality and one can't hide away from it?
So first, I think there's a collective sigh of relief and also a sense of achievement for India as a nation to have got where we have today. After a long journey, it now looks like the finishing line is genuinely close. To go back to your question on rates, the original recommendations, if you remember, were actually 3 slabs. One slab which would have been the standard rate, one for concessional rate of goods, and one for a higher slab for those goods which need to be taxed higher. And the idea at that point was there would be very, very few which would be in the higher and the lower. The bulk of them would be at one tax rate to make it simple. But one of the earlier speakers made an important point to say this is also, the attempt has also been to satisfy all categories of consumers in the country. So if you can move the tax rate to the closest to where it is right now, the people would obviously feel the least amount of pinch in the transition. There is going to be some pain in transition for sure. But I'm not even sure whether this is a revenue neutral rate because we don't quite know what would go into which slab in terms of the tax rates. I guess one needs to see the fine print, and only once the details are out can we figure out how the overall basket is going to tax the consumer of all kinds of goods. The sensible thing that has also been done is to remove a bulk of the items which go into the CPI index. About half of them, I'm told, will have zero tax. So at the bottom end, it is almost certainly not going to be inflationary. But it's still important to see how it pans out over the next few days as we get more details.
It's a fair point indeed. At the bottom of it, there is a zero rate, and they're saying that we're not calling this exempted, we're calling it a zero rate. Swami, come in on that because, economists like yourself were talking about, we were talking about a transparent GST, a simpler GST, a GST that makes India one tax, one nation. But these are 5 slabs that we're talking about. Do you believe the government, both in the center and the states, have perhaps done what was politically palatable to do? You cannot ignore the realities of a country like India, even though you're trying to change your entire taxation system. Could one have done without these multi-slabs that we are now seeing?
Well, let's just say that I'm glad that we've managed to take this one step forward. But as Vijay Kelkar said, we ultimately need to move towards one single rate. And when you see where we are and where we are going to get, we are just at the start of a very long journey. So GST is not one single act. It is a process. We have just made a start. As you say, 5 slabs is much too much. And it's even more than 5 slabs really. I mean, there are 4 slabs. There is zero rating. There's going to be something different for gold. There is going to be the cesses. There is going to be separate state tax on oil. I don't know where it's all going to end. The states are going to demand, in the name of flexibility, I think, a constant attempt to get additional either tax breaks or additional tax levies. The politics as it plays out today has been about every budget speech wooing this vote bank or wooing that vote bank. If suddenly you now say all the rates are fixed, I can't give any tax breaks, I can't give anything here, will that play politically, or will you begin to see sabotage of GST by the state governments and maybe even some departures in the center? I think this is the biggest political question which has not been attacked. This is not a technocratic issue ultimately. The thing ultimately is, are politicians willing to say that the days of playing games with vote banks are over, the rates are now fixed, and we are going to stick to this, and if possible collapse them into an even smaller number of rates. That is the proper technocratic way to go. It does not seem to me it is the way politicians want it to go. So if indeed this GST is going to be a success, it will require much greater discipline and a much greater understanding of the fiscal issues by the politicians concerned. I will merely say that I would agree with some people that the actual tax revenue that you get may be so much more than you expected that things will work out okay. At the same time, Vijay Kelkar has warned that compensation must not be given in full to the states, otherwise they will lose the incentive to implement this properly. All kinds of calculations of revenue neutrality are being assumed on the basis of proper implementation, which you cannot take for granted. So we need to have proper implementation, and for that, as Vijay Kelkar said, don't give full compensation. Give a substantial compensation, but let them have an incentive to go and implement these things properly. So as I said, we are at the start of a long journey. I think this is a decent first step to go, but there is many more steps to go, and the most important are not technocratic, the most important are political.
Indeed, the most important are political, and I must ask the uncomfortable question then, and Mukesh Bhutani, that's coming your way. Corporate after corporate, and I think Mr. Munjal mentioned that as well, you need to know the classification of categories. The question really is, with that 28% bracket there and having a cess, I'm going to discuss that in more detail. How is one going to distinguish between luxury cars and other cars? Is a Scorpio a luxury car? Is a Beamer a luxury car? And how do you also differentiate whether there's going to be a level playing field between bidis and cigarettes? On what basis will this classification be done? And don't you believe that will perhaps add to the problem, at least at the highest rate slab?
Absolutely, and that's the reason I said that I am opposed to the idea of cess, not because there is no precedence in the indirect tax policy elsewhere in the world to levy some form of a cess on demerit goods. But the question is, for India, what is a demerit good? If you are going to say that cars above 2000 cc engine or cars that exceed length of so many meters is classified as a luxury car and it's going to be taxed now as a demerit good, then what are you doing about it? And if you're doing it, then why aren't you allowing credit for those cess? That's exactly the problem. If you look at why our indirect tax system has been inefficient, why there are so many disputes insofar as service tax law is concerned, besides the dispute that arises out of rates of tax, it's classification issues. So what falls in the demerit category and what kind of car is a luxury car will give rise to classification issues and will give rise to disputes. And instead, what was being suggested is that if the only formula that the government wants to work to be able to compensate, or primarily with an objective to compensate the state government, is to levy cess, then in that case have a clearly articulated demerit goods. Don't try and push everything over there just because it is beyond the reach of the common man. So what happens if you start classifying now cell phones that cost above 30,000 rupees in the demerit category? Nothing stops them from doing that. You can say that the common man can afford a cell phone of only 10 to 15,000 rupees. I am going to put down now cell phone above 30,000 rupees in the demerit goods. What happens then to that industry? Uncertainty and a classification dispute that could arise. So I absolutely agree with you that what is to be classified as a luxury car is undefined, and that's the reason I am opposed to the idea of a cess.
Hold your thoughts there, and now that you've raised the point about cess, I must get Mr. Munjal to answer that question. And Mr. Munjal, so much was written and said by economists and experts like yourselves about there should be a tax, and cess is not the most transparent way, but it looks like policymakers both at the center and the state level have decided to throw their weight behind cess. At least on demerit goods, there will be a cess, and that kitty is going to be used for compensation. Hopefully, it will not be required going forward because compliance will take care of the issue. But are you someone who also objects to cess? I mean, I know Mr. Bhutani has a very strong view on that, but some other experts who joined on the channel said cess is perhaps a safer option that the government has taken, because anything on tax would have made the government levy the tax a lot more. 50% would have gone to the states, and the center would have got 50%, out of which 42% would have again been devolved to the states. And so the net impact of a tax would have been very high on the common man. Are you someone who objects to cess, or would you have still wanted a tax?
So in principle, there is always an objection to cess, for the very reason that Mukesh just mentioned, that it creates a cascading impact, and it also causes confusion as to classifications. However, having said that, I would say if the government and the states collectively agree that this is a temporary measure and would be moderated each year to take into account how much compensation is required by the state. So it should be set subsequently for the future years and phased out in the next 3 to 4 years, because there is no compensation going out after the year 5. If it is clearly defined as a temporary measure, and also very clearly defined upfront as to how this will be treated, what will get categorized, so there's transparency and we don't end up creating an additional problem, because the whole idea of the GST is to simplify taxes, not to complicate them. As it is, we have a multitude of taxes. I think Swami or somebody just mentioned that actually it's not 5, it's actually 8 or 9 categories, by the way, in all, if you look at this, some of the exempt items, some which are yet to be defined. So we need to find ways to not complicate it more than it already is at this moment. The whole idea of a GST is to improve compliance, to widen the tax base. The logic is quite clear. Cess actually militates against this logic, which is why there is a problem with cess. But as a temporary measure, I would still support it as possibly one of the possible options for compensation of the states in case there is shortfall. And again, I'm not even sure there will be shortfall after year 2, because if it's properly implemented, the expectation is there would be buoyancy in the revenues, and they would actually end up collecting more than they are right now.
Indeed, many people believe compliance is going to lead to that. Swami, the politically uncomfortable question is, and I know some quarters of Indian industry raised this on the show a little early on, that the desirable situation will be to see these rates converge, to see the multiple slabs that are there converge into a single or at max a double rate. Do you see political palatability to that move?
As I see the politics today, there is no chance of it converging. It is highly desirable. Vijay Kelkar had pointed out that if you have one single rate rather than 4 rates, the addition to GDP becomes 4 times higher. By having 4 rates instead of 1, you are losing 75% of the boost to GSP. And yet, as you can see, the demand is for more and more and more rates. Why? For that, I mean, when I went down to Tamil Nadu for the last state election, there was Amma wanting to give this scheme and that scheme and one more Amma scheme and one more Amma sanitary napkin and Amma kitchen and Amma's this and Amma that. Now, the tendency of politics is to have more and more giveaways, more and more tax breaks, more and more subsidies. That political culture, to me, does not sit well with this technocratic frame that has come out. I am in fact astonished that therefore we have got so far. I think it is a fantastic advance that we have got this far, that we are limiting ourselves to this number of rates, suboptimal though it is. Will we manage to get convergence closer? The question that you have asked, I would find that very difficult to believe in the foreseeable future. My real fear is that some state governments will find ways to sabotage it and begin to have even more multiple rates.
All right, even more multiple rates. Forget about these converging. But Mukesh Bhutani, just wanted to quickly touch upon the impact that the rate structure today will have on consumption patterns. I know classification of categories has not been done yet, but there are largely rates out there, and one does know what will fall where. What sort of an impact do you see this happening on both consumers and also corporates?
Now let's look at what the current scenario is today. The current scenario is today that there are certain items which are the common man goods item that are taxed between 3 to 9%. They all will fall under the 5% bracket. Then there are items that are taxed between 9 to 15%. They will fall in the 12% bracket. And then there are products that are currently taxed between 15 and 21%. That will continue to be levied tax at 18%, while the products that are taxed at 21% will go up to 28%. So you will be able to assess the impact only after you know what goods we are talking about. I also heard that there are certain items which were falling in the which were falling in the 18% list are being moved to the 12%. I would presume that those are for the common man as such. But until and unless you look at that list, you will not be able to assess the impact as such. Point number 1. Point number 2, you will need to look at the benefits of a GST system over a period of time. As the credit mechanisms improve, or in other words, the credits which are getting lost today as a result of many levies by the state government, be it by way of octroi or entry tax, and you will be able to assess what is the overall effective rate that gets passed on to the final consumer. That's the first point. The second aspect is if there is going to be a reduction in transaction cost because you're looking at a borderless levy or a one nation levy, then those also will need to be factored in. There could be savings arising out of that as well. So it's a combination of effective reduction or increase in the tax insofar as the final consumer is concerned, and over a period of time the supply chain efficiencies that you will be able to derive as a result of reduction in the transaction cost, and then only it will play out whether the GST system has resulted in a lesser burden to the consumer or higher burden in certain categories.
All right, I'm running out of time here and we'll let Mr. Munjal have the final word on this one. April 1, 2017 is a desirable deadline, but what if it is not met? Do you believe it will be in the interest of the government to push it by a year, or can October 1 or any time mid-year be a doable thing? As a member of the Indian industry, I'm asking you that question.
So what we had earlier said, Supriya, was that ideal situation is to start of the year, but we can move it to any of the next quarters after that, because accounting by companies is done by quarters. And at this moment it looks like it's actually possible, by the way, to implement in April if the central government takes up both the GST and the IGST in the November session starting in the next 10 days, and then the state simultaneously, because they have responded quite positively. So this is actually full marks, by the way, to the GST Council and to the Finance Minister in pushing this collectively to get it to this point. I think it does need the last push, and I will make one slight change from what I think Swami just said. I think we're all relieved and we are willing to accept an imperfect system to get this off the ground, because once people and the companies and the states and the government start to see the benefit, I think people will start to look at more efficiencies in the system, and then possibly also over a period of time alignment towards lesser number of slabs and rates.
All right, I was tempted to give you the last word, but Swami, you want to come in on that? Do you believe April 1, 2017 is a sacrosanct deadline, or do you believe any time within the year, if the government gets its act together, is doable?
As I said, GST is a process and not an act. So frankly, it doesn't matter which day you start, there is going to be a mess. There are going to be all kinds of glitches. So since that's going to happen, whether you have it on 1st April, 1st June, 1st October, you might as well start it on 1st April. I think that's the way to go. I'm impressed at the speed with which the GST Council and Mr. Jaitley are proceeding. I am impressed that it appears that these two crucial pieces of legislation will be passed in the winter session of Parliament. So whatever imperfect system we have on April 1st, I would say let us go with it.
All right, let us go with it. Thanks very much then all of you gentlemen for joining us right here on India Tonight. The voices that matter, Sunil Munjal, Swaminathan Iyer and Mukesh Bhutani. Thanks very much for being with us as we discuss and debate the big GST rates that have been decided today.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.